We're currently in the middle of an unprecedented surge in artificial intelligence investment, and this has sparked a major debate. Are we witnessing a true technological revolution, or are we just inflating another massive speculative bubble? In this explainer, we're going to break down the arguments on both sides.
So just how high are the stakes? Well, since early 2023, the market value of companies connected to AI has grown by an incredible $35 trillion. A number that big really frames the entire conversation and shows you the potential economic impact we're talking about, for better or for worse.
Here's how we're going to tackle this. We'll start with the sheer scale of the investment. Then we'll look at the warning signs that are screaming, "Bubble!" After that, we'll explore the counterargument, why this time might actually be different. Then we'll get into the strange financial paradox at the heart of the AI economy, before putting it all together to see what conclusions we can draw. And we'll finish up with a quick disclaimer.
Okay, so with literally trillions of dollars pouring into the market, we have to ask, is this boom built on a solid foundation, or is it all just speculative hype?
Let's start with the case for a bubble. For a lot of market watchers, today's AI frenzy feels very familiar, with some unsettling parallels to financial meltdowns from the past.
We're seeing a lot of the classic symptoms. You have startups with almost no revenue being valued in the billions. There's a rush of IPOs, with some stocks jumping over 60% on day one. And then there's this concept of circular financing, which we'll get into, and an incredible concentration of market value in just a handful of giant companies. Historically, that kind of dominance has often come right before a major market correction.
This chart really shows you the similarities. Back in the dot-com era, a company like Lucent would invest in a startup, and that startup would then use the money to buy equipment from Lucent. Well, today, tech giants are investing in AI startups, and those startups immediately spend that cash on the giants' cloud computing services. It's a self-feeding loop that can make revenues look much bigger than the real organic demand.
And this isn't just some fringe theory. We're hearing it from major investors. Ray Dalio, for example, has pointed out that today's AI investment climate looks very similar to the dot-com bubble, which adds a lot of credibility to this argument.
And to put the risk into perspective, think about this. The 2008 housing crisis wiped out $8 trillion in household wealth. The dot-com crash, $5 trillion. The AI market is already valued far higher than either of those were at their peaks. So a potential crash could have a much, much larger economic impact.
But now, let's flip the coin and look at the other side of the argument. A lot of major financial players are saying that comparing AI to past bubbles is just the wrong way to look at it. They believe this boom is built on something much more real.
One of the biggest differences is the financial health of the companies leading the charge. This isn't like the debt-fueled speculation we've seen in the past. Today's AI development is being bankrolled by the huge profits and cash reserves of established tech giants. These aren't just speculative startups. They're some of the most profitable corporations in the world.
And when you look at the data, the contrast is pretty stark. At the height of the dot-com bubble, the tech sector's price-to-earnings ratio was almost double what it is today. The biggest tech firms back then were trading at 70 times forward earnings. Today, it's more like 26 times. And look at infrastructure utilization. Only about 5% of the fiber optic cable from the dot-com era ever got used. Today's data centers, they're running at about 80% utilization. That's a huge difference.
So this is really the consensus view on Wall Street. Firms like Goldman Sachs and JP Morgan and even the Federal Reserve are arguing that this rally is justified. They're pointing to real earnings growth and transformative potential, and they're concluding that this is a structural boom, not a speculative bubble.
All of this leads us to a really interesting paradox at the very heart of the AI economy. It's a paradox that actually helps explain why both the bubble and the boom arguments can seem right at the same time.
So here's the paradox. The companies that are actually developing the AI models, the brains of the operation like OpenAI, are often losing incredible amounts of money. Meanwhile, the companies that provide the essential infrastructure, the picks and shovels, like the chip makers and cloud providers, are making historic profits.
If you follow the money, you can see how it works. It starts with a user paying a startup for an AI service. The startup then takes a huge chunk of that money, and often a lot more, and pays it to a cloud provider like Microsoft or Amazon just to run the models. Then, the cloud provider uses that income to buy billions of dollars in specialized chips from a company like NVIDIA. You see, the profits are all getting concentrated at the bottom of the stack, at the infrastructure level. Now, a big part of the problem here is a lack of transparency. Many of the key AI players, like OpenAI, are private companies. So without public audited financial statements, it's almost impossible for anyone on the outside to verify their revenue claims or to know just how much money they're really losing. It makes it very difficult to judge the true health of the entire ecosystem.
So, how do we make sense of these two very different stories? Are we in a bubble or on the verge of a breakthrough? Or could it somehow be both?
On the one hand, you've got the bubble narrative. This story is all about speculative mania, questionable financial loops, and unsustainable valuations. But on the other hand, you have the boom narrative, which points to a genuine technological shift that's backed by real profits, strong balance sheets, and tangible infrastructure built to meet real demand.
This quote really seems to capture the situation perfectly. It suggests that it's possible for a technology to be truly world-changing, while at the same time the market for it becomes completely irrational. We've seen this before. Railroads transformed society, but their stocks still crashed. The internet changed everything, but the dot-com market still collapsed. The key takeaway here is that a revolutionary technology and a speculative bubble are not mutually exclusive.
And this leaves us with one final and very important question. If AI really does deliver on its promise to revolutionize everything, does that justify the enormous economic risk of what one famous economist called a casino economy? It's a fundamental trade-off between progress and stability, and it really defines this entire debate.
And before we close, we need to provide the following disclaimer.
The information presented here is a market study based on sources that are publicly available. It is for informational purposes only and should not be taken as investment advice. Thank you for your time.